New York State Attorney General Eric Schneiderman is with us. He has been investigating high-frequency trading. Welcome.
Thank you.
So they have an advantage, high-frequency traders, as shown by Michael Lewis and Steve Croft. Is it illegal?
High-frequency trading in the sense of fast electronic orders has been around for a while, not illegal. What Michael is talking about are high-frequency traders who use their speed to take advantage of cracks in the foundations of our market. As I think he explained in the 60 Minutes piece, we now have more than 60 public and private markets that are linked up, and there are cracks. There are places that you can get to faster than other people and front-run the market. What's improper is front-running the market, is using any special advantage or edge with your speed to have an unfair advantage over anyone else. There's an assumption in the markets that everyone's allowed to do research, but they're fundamentally fair.
So is what they laid out last night illegal?
Some of it, I believe, may be illegal. Our office has had an investigation for over a year into some practices related to high-frequency trading. There was a situation we dealt with last year where we found that Thomson Reuters, which releases surveys of consumer confidence, was giving a 2-second edge to an elite group of subscribers. And in that 2 seconds, the high-frequency traders were able to move the markets. To their credit, Thomson Reuters stopped doing that. But there are situations where there really may be some illegal conduct, and we are looking at it under New York securities laws.
But the average investor hears this report and hears the stock market is rigged. And you say you're not sure whether it's illegal or not. What are you going to do?
Well, two things. One is that we're shining a light on this whole problem. That's why we started talking about it over a year ago. I think Mr. Lewis's book is going to help us in shining a light on this problem. There are two things we have to do. One is we have to investigate, and the Commodities Future Trading Corporation, the SEC, has to investigate whether there's anything that is currently illegal. The second is this clearly requires new laws and reforms to catch up with the changes in technology.
Who's doing this? Who are the bad guys?
High-frequency traders are firms all around the world. They're massive investments, and there is an incredible race for speed now. People are paying hundreds of millions of dollars to shave milliseconds off. It's used by all different kinds of firms, including some perfectly legitimate firms. But the high-frequency traders are these amazing combination of scientists and analysts that are just shaving speed every day.
Which brings up the interesting point. The young man last night who found this out has created an exchange that by delaying the high-frequency trader says he evens a playing field.
Correct. And that's what they're called speed bumps. Right. If you put a speed bump in, it slows it down. Now, there are different ways to build speed bumps. I've proposed a different kind than what IEX is using. But it's clear to me that we need speed bumps for two reasons. We can prevent unfair advantage, and we can avoid the destabilizing effect that high-frequency trading can have, because in this race for speed, it provides an incentive for people to engage in more and more risky behavior to shave those milliseconds. And as we know, that can produce flash crashes and other problems.
These are fractions of a second.
Incomprehensible, really. Milliseconds are something that you can't even get your mind around. But boy, can they move markets with these automated robot computers that are just triggered to shoot out offers and shoot out trades as soon as one factor changes.
Incredible reporting. We'll wait to see if there are some changes. Eric Schneiderman, thank you so much.
Thank you.
Good to have you here.